Hey Rob, I'll do this in a short video that might make it easier than just trying to type it out. First example that you've given me is the NASDAQ on the 27th. Now, the first thing with the indexes is that they don't even open until 9:30, so that's not even an issue in terms of the 8:30. But you have to also consider that when you're looking at any of the instruments, number one, what is the setup that you're actually looking for? So in this particular case, we have an inside day. Our bias is already to the downside, and we're looking at potentially attacking the low of the month from the first day, but also the previous month as we come into the 27th, which of course is a Thursday. Now we have the inside day. The reason I'm painting this is that no matter what you're doing, it's when you're approaching that market, regardless of the time per se, is what setup is it? So we're looking for the short continuation trade. It's a Thursday. We're already in a broken down market. So we've closed in breakout on the Tuesday, pumped up. Now here's the easy thing. The first thing always is what is the setup before you go to an EMA or anything else. So we have our high bull from the previous day. It's an inside day on the Wednesday. And so we have a level already projected when we come into the Thursday as a potential area of selling. So anything above there in the previous days has sold off, correct? And so that level may have significance into the timing window. And now on the 5-minute chart. So next thing you want to do before we get into the US window is the area that is the high area above there where they've broken down. You can just see, I'll highlight that. And all we're doing now is waiting for the market to give us the entry signal. So the key thing is this. If you're getting in that first hour in any instrument, you have this lower low. We're looking for the pump up. The pump up. This is the setup right here. It's not, if you put the EMA on here, I'm going to show you a couple things with that. Number one, the highest area of that EMA, if we highlight that, is right there. And you'll notice we're pumping into the highest EMA area, which is also now the highest level of the day and that level that we projected across. And then we're just waiting for the market to open. At 9:30, we have our pin hammer engulfments. This is a 5-minute chart, and this is an opportunity now when you have the space below there, before we get to where the pump began, if you're going to be adding additional positions in. But once you have that thesis already in place, I'm going to show you something else that you can use. This is now the 1-minute chart, and this is why once you have your level already in place, it has nothing to do with candles, it's about getting in. We have our extreme locked in. So if I'm on a 1-minute chart, as this market's breaking down, I can be adding positions in up until a certain point. We can even project the pin hammer level across as a maximum area of where we want to stop scaling in. And then once this market collapses through, we're at break even on all positions, and our stop loss max area is a 1-bar area up top. So it's about the level, not about the moving average. The average is just there for visual confirmation, and I'll show you something just to cement that. Once you have this hive date level at our projected level from the previous day across, just recognizing visually you're pumping back up into the high of day. There's our engulfment right at the open, and you don't even need the EMAs. So with the indexes, remember 9:30, and secondly, if you're at an extreme high or low of the week, the 4-hour rotation, which means that 10 a.m. is going to be the most likely entry point for either a reversal, especially when you're at the high or low of the week. In a continuation move, okay, we're continuing. If we go back to our higher time frame, we're already in a trend. 9:30, in line with our 4-hour rotation, right? 6 a.m. is the new 4-hour rotation. They've pumped up at 6 a.m. 9:30 now can be the trend trade opportunity at the open of a session. Indexes though, 9:30. Okay, so the second example is March 4th on gold. Now we have a first green day on gold at the beginning of the month, coming underneath of a first red day from the end of February. This is a daily chart. So I want to reinforce, number one, if you're just looking to trade on the shorter time frame, the first thing you have to have is a setup before you put an EMA on there. And I will just tell you, with the metals, I'm specifically looking for certain setups. And what I mean by that is I'm looking for the metals to be closed in breakout at the extremes of weekly levels. I'm not, I'll take a pump and dump on a gold chart, but specifically I'm looking for markets that close in breakout on the metals. Now, if we have a higher time frame setup, first red day collapse, for example, this market's broken down. We have selling all underneath of that level and a lower low. That market is now set up for a session collapse in London. We come along, obviously the US is low-hanging fruit. Broken down markets are going to be easier to sell for quick collapses. So in this particular case, if we come back to where we're at, on March 4th, we have a market that has pumped up. We're outside at an extreme, coming back to our higher time frame understanding, and just projecting levels across. So we have a high of day level we can bring across on the 4th itself, and just using a 15-minute chart. So we want to know that we have a level in place. And I really encourage people to not just try and sell something because it's up high. So first thing we need to do, though, and what I mean by that is if traders are constantly trying to sell on the front side, okay, the market's breaking out and making higher highs, let the market coil and break down and coil before you go to your EMA. So we're on a 15-minute chart. There's our pin hammer at 9:30 after the engulfment. Now, just on a 15-minute chart, if we put our basic EMA on, so remember, we have a market that's going up, and we're trying to sell against a market that's going up. So if that's the case, I need the market to break down and go sideways. So we're trying to sell up high against a market that's actually in breakout, as opposed to, if we go back, I'll put the 1 hour on here, go back and sell a market that's actually already breaking down, pumping up, breaking down. So we have a market on the Friday, Monday, Tuesday breaking down. This is an easier sell on the backside as opposed to trying to sell on the front side. This market is Monday, Tuesday has broken out. We're trying to counter trend a market in breakout. We go to our 5-minute chart, and that's our level from the 15 minute. So again, if you're just trying to catch get inside of an EMA, remember first hour. So we have an engulfment rate there at the high. Hopefully you can visually recognize that on the 5-minute right here is our first level where that engulfs. It pumps back up. You don't have to get in early. We're in a market that's in breakout. So once we have this collapse, you can get in up here. And this is the beautiful thing. If you break, say, your whole position, if you're going in one position, this is a nail and bail for sure. Breaking that into smaller positions, entering, getting a position in the market, and letting the market confirm your thesis. But once this goes sideways, this is the area you want to be getting in. Remember, we're counter trending a market that's in breakout. This isn't the same as a market that's closed in breakout. It's broken out. We have our pump up. The first target area is going to be the low-hanging fruit, the bodies, right? I always sort of highlight underneath the bodies because once the market comes down here, all the buying is above the body level, and we get our vertical collapse. But the sideways movement is the safe bet. So just getting in on a cross of an EMA, remembering we're still going higher on the EMA. Let the market break down and coil sideways. And all this is, in simple terms, is the first hour. As soon as 9 a.m. starts, bang, straight down. So think in terms of an hourly rotation, positioning ourselves in the market. Our worst case scenario is going to be a 1-bar stop. If that's our max risk, we can even go tighter if you're more patient and just entering. And if you're going to add in as it's collapsing, this is the safe trade as it's blowing off vertically. But just getting in on the front side of a move is going to, number one, put you under heat. But remember, instead of just trying to counter trend a market that's going high because you're at the high of the day, think back into simple terms. What setup is it? And that's the things what's happening with people is they're constantly just trying to sell the high when it's up high. Think about the big picture. Where's the easy money? The easy money is trading once the market starts to break down. If it breaks out, let the market break down and coil. The sideways coil is where the safe trade is. And you'll notice we're still sitting up high today. It's broken down. But day 1, day 2, day 3, right, midpoint range of the week. And this is an easy trade for London session traders. We're on the backside of the week. There's no heat on this particular trade. And this is a great example. Again, day 1, day 2 on the backside, we can project that last shoulder of the US window prior to the day opening. They've gone up. They've put the high of day in place. We don't even need our EMA until we have a setup. We're heading into our Europe-London window. We have a lower low. There's our pump right there. We don't even need to worry about any of this stuff. We have trap volume up high. There's our engulfment back inside. Remember, the highest point of the EMA is already up here. So the high of day is potentially already locked in. They've pumped it back up. We're back inside of our EMA. Easy money all the way back down to the low of day level. So hopefully that helps.